I have done countless of videos on PayPal 4 months ago, 7 months ago. I even did a video a year ago, and pretty much every time I make a video, PayPal makes a new 52-week low and it keeps going down. But in every single video, I said pretty much now is not the time to buy PayPal. And I said in this video 10 months ago, you must watch this before buying PayPal. And I was talking about the whole macro environment, that it's not good for such companies, because unlike other YouTube channels, we don't only focus on DCF or only focus on the PE ratio, we also focus on the macro environment that impacts the earnings of a specific company, as PayPal will get impacted if we have a recession or if we have a macro environment. So you cannot just do a DCF based on the past 10 years if the next 10 years or the next 5 years are different. This was one of the main ways I was able to avoid PayPal, and now it's sitting at $69 per share, close to its 2017 price, although PayPal is a much better company than what it was in 2017. So the question is it finally the time to buy PayPal stock, as it's sitting pretty close to its 2017 lows? It's now trading at a 15 PE ratio. It used to trade at a mean of 37, and it traded as high as 66 times earnings on the PE ratio, the forward PE ratio. So is it finally the time to buy PayPal, or if we maybe still wait for a little bit of a better price, even though the stock is down so much? This is the questions that I'm going to answer in today's video. So again, I hope you enjoy it. All right. Now, I'm not going to do a deep dive on PayPal, as I did many videos on it. And most of you are familiar with the business PayPal. Many of you used it. Many of you used Venmo, which is owned by PayPal. And this is the whole PayPal ecosystem. But in my previous videos, I was very worried about the operating margin declining. When I made the video, it was, I believe, around 23.8%. And it has declined a lot. But it started to pick up in Q3 of 2022 as PayPal was doing many initiatives to reduce costs, reduce many other unnecessary costs to try to help the margins. And I'm very satisfied with what the management was able to do. And operating margins are finally started to pick up again. And I'm very happy to see that from the company PayPal. Now, their active accounts have been growing. Actually, they have not been declining, but the growth have slowed down, and this is what really scares the stock market. Whenever you have a stock priced at 35 times earnings and then the growth gets cut in half in terms of revenue growth or in terms of the active accounts, which is something very important for PayPal, again, it really hurts the valuation, it hurts the multiple, and it did hurt the stock a lot, as now the accounts are only growing 4% year on year, which is really still not bad for the company, and especially at the current valuation and at the 15 PE ratio, which I believe is very fair for such company and is pricing in those numbers. Now, PayPal is trying to do many things to retain users and help fuel their growth again. One of them is the PayPal reward program, where you could get rewards for spending money on PayPal, which is a very smart idea, and it wasn't in place before. And this is another very clever initiative from the management with what they are trying to do in terms of retaining users. Now, another thing PayPal is trying to do is trying to score partnerships with Amazon, which it did in terms of Venmo, where people can pay with their Venmo account on the checkouts. They are also working on a partnership with PayPal on a couple of other things, which is really good and is going to help the company going forward. But there's a lot of things that's going to hurt PayPal. One of them is competition. You don't only have PayPal right now. You have, Square Pay, you have Amazon Pay, you have Apple Pay, you have Google Pay, you have Shop Pay. You have many of those popular companies, especially Shop Pay, which is on Shopify. Many people are trying to use those products instead of using PayPal. There's no main way to use PayPal, as PayPal is not really as different from any other thing. Like, people don't say, oh, I prefer using PayPal over Square, or I prefer using PayPal over Amazon Pay or over Shop Pay. The main thing that set PayPal apart for many years was its reputation and its trust. And we can really argue that some of it has starting to go bad in terms of PayPal, and especially when something they did which went viral. It was a very stupid decision from the management when they said they want to charge $2,500 on users' account if they promote misinformation or something like that. And this really went viral on Twitter. It went viral on all social media and all the news networks. Many people canceled their PayPal. Many people don't trust PayPal anymore. I'm not saying PayPal is going to zero. I'm not saying PayPal's trust is completely gone. But if you're a PayPal shareholder, if you're looking to invest in the company, you have to acknowledge such things, that this was a very bad decision from the management, which they did correct, but it led many people to question their trust about using PayPal, and they are considering PayPal not really different from any other type of payment application. All right. But PayPal, I really like what they did again with the management. Although I am not a big fan of the buy now, pay later, but at least they haven't overpaid for something like Afterpay, like Square actually did. They started their in-house buy now, pay later, which, as many of you know, is actually growing very, very fast. But I am not a fan of the industry whatsoever. I think it will ultimately go bust, as many of them are lending people who are not qualified, not based on their credit score, based on some type of an other credit score, which is really not accurate. I have seen things with Affirms. There's many consumers late on their payments, and I am not a fan of this whole thing in general. But PayPal is not as exposed as other companies, which makes me feel pretty comfortable about this company. And PayPal, again, is a free cash flow machine, although I like focusing on the PE ratio and net income, mainly to take away stock-based compensation, as it can really mess up the free cash flow for those tech companies and make it look better than it seems. But again, the management is doing the right thing in 2022. You could see the yellow line here. They are not putting money in CapEx. They are putting money in stock repurchases as their stock is getting killed. And this is one of the best ways they can actually return value to shareholders. And I believe they are doing the right thing in terms of focusing most of the money actually on stock repurchases and by cutting on CapEx, which is again very, very smart and very, very good from the management. Now looking at their shares outstanding, they have been going down, especially if you look from the first of 2021 to mid 2022. I don't have the latest number, but I believe it's much lower than 1.1 million shares. So again, PayPal has been returning value to shareholders by buying back stock as the stock has been getting killed, and I believe they are doing very well on this thing. Now looking at the revenue growth, this is what really scared a lot of people with PayPal, as the company was growing between 15 to 70%. Now this growth really slowed down from 18% to only 8.5%. And I believe it could slow down more into 2023 as we are entering a global recession. And this is the whole thing I'm going to talk about in my valuation model to determine if PayPal stock is a buy at those prices or if it's maybe still a little bit expensive and we should maybe wait for a better price. Now, this is my valuation model on PayPal. They made $27.5 billion of revenue. Currently, I expected only 5% revenue growth in 2023. Now, why am I doing that? Because I believe PayPal will eventually really suffer in 2023. It's going to be the worst year for those type of payment systems, for Visa, for MasterCard, for anything around spending, as the Fed is hiking rates. We are entering a global recession, not just a US recession, but a global recession. And I believe 2023 is going to be the worst year for all those companies, and 2024 is going to start getting better. Therefore, I'm not putting 8 or 10 or 12% growth for 2023. I took it from the 8% they are growing in 2022 to 5% to account for the global recession. And I could even make negative growth in 2023, but I believe they can keep growing around 5%. Now, in the future, I did not put PayPal back at what it used to grow, 18, 20%, 15%. I think this is behind us, and I think there's much more competition, and PayPal is a much more mature company going into the future. So I believe an 8% sustained revenue growth is very fair for the company. Although they might be able to get back to 15%. But that would be a big gamble for me to bet money on that. So I would prefer to be more conservative and look for the worst case scenario instead of the best case scenario, which is still around an 8% growth every single year. And I believe PayPal can actually sustain it. All right. Now looking at the net income margin, 70%. I use the same 17% net income margin. That would be around, roughly 6.5 billion of net income by 2027, which is 5 years from now. Now on the PE ratio, I only used a 20 PE. Although PayPal right now is not trading at a 20 PE. PayPal now is trading around a 15 PE. But I believe it's going to trade around a 20 PE, as 2022 and 2023 are going to be one of the worst year for PayPal stock, and I believe PayPal could get back to some kind of a sustained 20 PE ratio after the uncertainty goes away, after what the management is doing in terms of cutting costs and doing a couple of other things, getting back their operating margins to start getting to around 24-25% again. So I'm very happy with what the management is doing and with all the buybacks they're doing at those very low prices, and I believe PayPal can actually get back to around a 20 PE ratio. I would not be betting on anything higher than that. Now, PayPal is around an $80 billion market cap right now. If we take all those numbers, we get around 133 billion and a half market cap in 2027, and this is only a 67% upside over the next 5 years, or 11% compounded every single year for the next 5 years. And this is not including any shareholder return you could get from buybacks. And it's really crazy for me to say, but despite PayPal going to $69 per share, my conservative model is still saying that PayPal is not as cheap as you might think. Now, there could be many different things that could happen. If PayPal gets the growth again and trades at a 25 PE, this is over a double over the next 5 years, which would make PayPal an amazing buy. And this could all happen. PayPal can grow 10% again. PayPal can get back to 25 PE. But this is not something that I'm personally willing to bet on, especially as the entire stock market is going down. And you have many more options in the market than just going with something like PayPal. So therefore, I believe PayPal is not the best buy in the market. It could surprise to the upside and double up over the next 5 years. But this is not something I would bet on. And this is not something I would be comfortable, putting my money into, as I believe, we're going into a pretty big recession in 2023, which I believe could make an amazing buying opportunity into PayPal and many of those other payment-related type of stocks. Now, this is my video for today. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.